Have you heard the expression, it's not what you make, it's what you keep? That's why it's so essential to understand real estate taxes. How's it going, guys? It's your boy Mike, and my mission is to help 10,000 people gain financial freedom with the help of real estate. Now, in this video, I'm going to talk about the 4 best real estate tax benefits that you should be taking advantage of in the US. Now, it's tax season right now, which means Uncle Sam is probably kicking your butt. Now, as usual, the government is making questionable decisions, like hiring thousands of extra IRS auditors to keep wage normies and brokies like you and me in check. But if you have rental properties or other forms of investment real estate, you could be clapping back at the US, hitting them with the old turntables, and laughing all the way to the bank. So don't forget to subscribe and stick to the end of this video to learn all the special tips. Now also, please like the dang video, fellas, and listen up so you can be ready to employ all 4 of these strategies to save that paper. Starting with number 1, deducting your expenses. Now, one of the most significant benefits of rental income is the real estate tax deductions that you can take. You get to deduct expenses directly tied to the operation, management, and maintenance of the property, such as property taxes, property insurance, mortgage interest, property management fees. I'm sure you're paying them 10% a month to manage your property, and the cost to maintain and repair the building. But did you know there are many other ancillary expenses that you might have forgotten to write off? Qualified real estate expenses may also include the following: advertising, office space, business equipment. Did you buy a new smartphone, laptop, printer, any of these things that you use for real estate related purposes? They're potentially write-offs. Legal and accounting fees, real estate books and courses, and travel, my personal favorite. Make sure that any trip you take, anywhere you go, remember to set up a meeting or a phone call with a local agent to talk about the local rental market, and then write off all the travel costs as one extensive research and expeditionary trip. You're literally Lewis and Clark surveying the unexplored real estate Northwest, and I, your humble guide, will show you how to save money by doing it and writing the trip off. Now, these deductions lessen your taxable income, which should save you money when you file your taxes. Most of the real estate investors that I know have enough qualifying expenses combined with other deductions never to pay any tax on their rental income. So let's get good and try to learn the game and be a better player. The pro tip is be sure to keep detailed, accurate records and receipts to prove the expenses you claimed if you're audited by the IRS. Tip number 2, depreciation. Now, depreciation is the total loss of an asset's value over time, generally due to assumed wear and tear. Now, as an investor that holds income-producing rental property, you can deduct depreciation as an expense on your taxes. And this means you'll lower your taxable income and hopefully reduce your tax liability, or the amount you owe. You're allowed to take the depreciation deduction for the entire expected life of a property, currently set by the IRS as 27.5 years for residential properties and 39 years for commercial properties. Now, unfortunately, it's complicated to make these deductions because you have to differentiate between the value of the house/property and the land that it sits on. Now, I recommend using an excellent CPA to stay on the up and up and avoid any IRS issues. Now, once you sell, though, be prepared for the coming fist fight with the government. They're going to want their money back, and they're going to require you to pay the standard income tax rate on the depreciation that you've claimed. This is known as depreciation recapture. But let not your hearts be troubled. The financial Big G has a few more arrows in the quiver to fight back with still. Tip number 3, capital gains. Now, unlike the gains that we're all trying to make at the gym, capital gains are a little less ideal because of the tax burden the government is going to put on you. A capital gains tax is assessed when you sell an asset, like a rental property or stock, for profit. Now, there's 2 types to be aware of. There's short-term and long-term gains, and they each impact your tax situation differently. You realize a short-term capital gain when you profit from selling an asset within 1 year of owning it. You really shouldn't sell in this window if you can avoid it. But if you're forced to sell, be aware that doing so sucks when the tax man comes knocking. That's because the gain gets counted as regular income and taxed at your standard income rate. Or worse, bumps you into a higher tax bracket, making you pay even more. Now, on the flip side, you see a long-term capital gain if you profit from selling an asset that you've held for a year or longer. If you can wait until the anniversary of your purchase to sell, you'll get to keep more money in your pocket. And that's because the long-term capital gains tax rate is significantly lower than the tax rate on income. Well, provided that the current administration doesn't double or triple the long-term capital gains rate like they've been threatening to do. But until then, long-term capital gains are not counted as income and are taxed at a lower rate. Now, tip number 4, The government has developed special tax code loopholes, like the 1031 exchange, that incredible people like you and I can benefit from. However, the price of admission into the Cool Kids Club is liking the videos, so don't be lame like I was back in high school, playing my video games and getting 0 ladies. Instead, like this video to become a certified real estate G. I will be sending certificates out with that on it at some point. The 1031 exchange exists because the government wants to reward people who reinvest their real estate profits into new deals, as long as the new property you buy is of equal or greater value than the one you sold. The program lets you swap the properties for tax purposes without creating a taxable event. So you get to defer paying those sales taxes until you would sell the property you exchanged into. Now you can use the 1031 exchange indefinitely. If you cash out of your profits, you'll have to pay the tax owed. But on the other hand, you could put all that property into a trust until you die and then leave it to an heir, and you'll have avoided a large amount of the tax burden. So consult with a 1031 specialist to get the guidance that you need. These are indeed the best tax benefits that you need to be taking advantage of if you're going to even stand a chance in the ring against the I, the R, and the S. They want to keep you down, beat you up, and never let you escape the middle class, so you got to pull up strapped, packing some tax loophole heat, ready to defend what's yours and tell the feds to kick rocks. So if you liked the video, subscribe to the channel because we keep it real here by trying to keep more of your money in your pocket. Thanks for watching, and I'll see you next time.